Good morning. It is Tuesday, May 19th, 2026. This is your deep dive daily briefing. I am your anchor, delivering a comprehensive analysis of the pivotal events that have defined the last 24 hours. We begin our broadcast on the world stage in Paris, where finance ministers and central bank governors from the Group of Seven nations have convened for a critical two-day summit. The overriding focus of these high-level talks is the unfolding economic fallout from the war in the Middle East and the ongoing commercial paralysis surrounding the Strait of Hormuz. United States Treasury Secretary Scott Bessent, fresh off what he described as a highly successful bilateral delegation to China, is leading a concerted push to urge G7 partners to maintain a unified sanctions front against the Iranian war machine. This diplomatic offensive occurs as the international community attempts to forge a consensus on the rapid reopening of the vital waterway, which has been largely blocked since the outbreak of hostilities on February 28. The stakes are immense as the confrontation has already cost companies worldwide an estimated $25 billion, a figure that continues to climb daily.
Transitioning from the halls of international diplomacy to the ground level of global commerce, Tehran has taken an aggressive step toward institutionalizing its grip over the region's primary maritime artery. On Monday, Iran's Supreme National Security Council officially announced the formation of a new regulatory entity, known as the Persian Gulf Strait Authority. Operating via official communication channels, this body has begun issuing formal regulations to commercial vessels wishing to traverse the Strait of Hormuz, effectively attempting to implement a permanent sovereign system of traffic management and transit tolls. This regulatory offensive crystallizes a long-standing warning from the Iranian Revolutionary Guard that maritime traffic through the choke point will not return to its pre-war status. While reports from inside the negotiations suggest that Washington has offered a temporary waiver of oil sanctions in exchange for a comprehensive peace deal, the official creation of this authority indicates that Tehran is actively positioning itself to dominate the waterway regardless of the diplomatic outcome.
This structural fragmentation of global trade routes is forcing a profound reassessment of international financial stability, a reality that is presenting an immediate test for the new leadership at the Federal Reserve. Kevin Warsh has officially assumed office as the 17th chair of the Federal Reserve Board of Governors, following his confirmation by the United States Senate and the official conclusion of Jerome Powell's term. Warsh steps into the role amidst an unusually divided central bank and a worsening inflationary backdrop, with consumer prices recently climbing to a three-year high of 3.8% year-over-year. Institutional investors are watching the incoming chair closely, as he has previously been a vocal critic of past policy errors and has advocated for a regime change focused on price stability over asset price insulation. J.P. Morgan wealth management strategists indicate that financial markets are currently pricing in a prolonged pause, with expectations that the Fed will keep interest rates steady through the remainder of 2026 as Warsh attempts to anchor long-term expectations against energy-driven shocks.
Turning our attention to the technology sector, the macroeconomic headwinds generated by this prolonged conflict are accelerating a massive, state-sponsored push toward domestic energy independence and advanced computing infrastructure. International Monetary Fund staff, concluding their latest consultations, have noted that while the tech sector continues to benefit from a powerful global artificial intelligence boom, the broader economy faces clear upside inflation risks from rising domestic energy costs. In response, advanced digital economies are aggressively moving to integrate AI into national growth strategies while shielding their physical infrastructure from global energy market volatility. The transition toward localized high-density power solutions is becoming a commercial necessity, as computing tasks associated with next-generation agentic AI clusters continue to face unprecedented grid constraints. This reality is forcing tech giants to move away from centralized public utilities in favor of self-sustaining, vertically integrated power systems to ensure operational continuity in an era of geopolitical instability.
Finally, we look at the logistics and supply chain networks that serve as the vital arteries of global commerce, which are now absorbing the permanent structural costs of a permanently rewritten maritime map. The International Monetary Fund's latest baseline analysis confirms that short-lived supply chain disruptions have now transitioned into structural barriers, putting severe operational pressure on energy-intensive and trade-related industries. With the newly formed Persian Gulf Strait Authority attempting to enforce strict regulatory compliance and toll collections, major maritime carriers have finalized the total integration of alternative, longer trade lanes. Logistics professionals report that the era of secure, low-cost maritime corridors has effectively closed,
replaced by a permanent reliance on regional inventory buffers and multimodal air-rail corridors. This defensive realignment has fundamentally altered the economics of world trade, locking in higher freight rates and extended transit times that are systematically driving up the baseline costs of raw materials, petrochemical products, and agricultural fertilizers worldwide.
In summary, the global landscape is defined by a critical G7 summit in Paris confronting a $25 billion disruption to world trade, occurring just as Iran formalizes its sovereign control over the Strait of Hormuz through a new regulatory authority. The Federal Reserve has entered the hawkish era of Kevin Warsh amidst 3.8% inflation, while the technology and logistics sectors finalize permanent adjustments toward energy independence and high-cost, regionalized supply networks. Based on the current data, I predict that Tehran's official creation of the Persian Gulf Strait Authority will prevent a rapid return to pre-war shipping costs, even if a diplomatic breakthrough is achieved in the coming days. By establishing a formal administrative mechanism to govern traffic and collect tolls, Iran has effectively created a permanent geopolitical premium on the world's most vital energy bottleneck. Consequently, the structural inflation currently impacting global logistics and commodity markets will likely persist through the remainder of 2026, forcing Chairman Kevin Warsh's Federal Reserve to maintain a highly restrictive monetary stance and keep interest rates higher for longer than Wall Street currently anticipates.